there's lots of ways to skin the cat, lots of different ways you can put your deals together. We're going to talk about three of them today, starting with joint ventures. And a joint venture is really nothing more than people coming together to do some project together, some venture. If there's money involved, which there usually is, everyone's investing their own money into the deal. Everyone is actively participating in the deal. Everyone's got a role. There are no passive investors sitting here in our joint venture. And generally, because of that, everybody involved in the deal has extensive personal liability. So the simplest form of a joint venture is going to be a general partnership, which is the worst way to do any kind of activity. Don't ever form a general partnership, please. And the reason general partnerships are so bad is because you have not only unlimited personal liability for anything you do, you have unlimited personal liability for anything your partners do. And so everybody's sharing all this liability. It's really terrible. Now, that doesn't mean don't do a joint venture. Just don't do one as a strict general partnership. So what we're going to want to do is mitigate liability in our operation by using business entities in the structure of our joint venture.
I always think with joint ventures, it's just such a buzzword. It's almost like, crowdfunding. What does crowdfunding really mean? What does JVs really mean? And I think that's kind of one of the biggest kind of issues is legally it doesn't mean anything.
Right.
Which I think is kind of the biggest issue. But how do you, Richard, if you were working with somebody and they say, hey, I'm looking at doing a joint venture, how would you explain it to them? Do it this way and just be smart about making sure that you're using entities and protecting yourself.
Yeah. So if I'm consulting a client, I have a lot of clients come to me here. Oh, I want to do a JV with so-and-so and so-and-so. We're going to do this thing. We're going to start this business or buy a property. We're going to have a discussion about, okay, who does what, who's bringing what to the table. We might even put it up on, an org chart and on our, screen sharing software and kind of say, what are all the moving parts? And then, okay, how do we make this business operate the way you want to and protect everyone involved, particularly the client we're representing? Sometimes we're representing multiple parties. Usually, we're representing one. How do we protect you within this structure? And then we'll build it out. Most of the time, this is just going to end up being an LLC or a group of LLCs, with various ownership percentages, various responsibilities, various capital contributions, and we just kind of work it out however the partners want their business to work.
Well, let me ask you this. I love S Corps. I think they make a lot of sense sometimes. In what situations would a joint venture, you do it through an S Corp versus an LLC?
I frankly don't like using corporations at all, and I avoid them when all possible. The big thing about an S Corp is not so much the entity, the legal entity itself, but the taxation. And so, in which LLCs are kind of chameleons in that sense. They can, for tax purposes, be corporations or be partnerships or even be sole proprietorships. So there are, especially for service businesses, there are significant tax advantages for being taxed as an S Corp, whether you're doing a bona fide S corporation or you're doing an LLC that's simply being elected, that's simply electing to be taxed as a corporation. Now, bigger deals, if we're going to go public or we're going to do something, maybe we talk about using C Corps or, an actual C Corp, for instance. But for most deals, for most clients, where we're kind of playing in the, $1 million to $30 million kind of realm, I pretty much use LLCs across the board to accomplish anything I need to.
And is it just really because of the flexibility, and you really nailed it with the S Corp? We'll use it primarily when it's a single member ownership. But if there's multiple partners, then you can always elect for an LLC to be an S Corp, if it makes sense. But the reason
I've got my underlying PLLC for our legal services is a single member LLC tax S corp, and that the reason I do that is it helps me avoid a lot of payroll tax.
And that's a good thing to do. Nobody wants to pay any taxes. Well, sounds good. And if anybody has any questions about JVs, I know that these things come up all the time. Again, just shoot it into the Q&A. And otherwise, we can just kind of move on to the next subject, unless you have more that you'd like to dive into there.
Yeah, no, I think you just made an important point, though, is that, JV is kind of a generic term. So there's a lot of, it's like deal. Well, what's a deal? Well, deals can take all kinds of forms. JVs can take all kinds of forms. So, and it's just a generic term for multiple parties coming together to do some business activity. So with that, I'll roll on to my favorites, my bread and butter, syndications. And syndications differ from joint ventures in that some of the participants are active and some of the participants are passive. So the way a syndication works is you have deal sponsors, often called GPs, and GP, this is leftover terminology from when partnerships were used to put these together. The GPs basically will pool money from passive investors in order to make a specific transaction or fund a specific business. So the sponsors, the GPs, are the only active participants in the deal, and all the other investors are passive investors, or what I like to refer to as houseplants, because that's all they do. They just sit there, they provide green, and then they sit there and do nothing. Passive investors have the advantage of limited liability, at least as long as things are structured properly. So in a typical deal, an investor's exposure is going to be limited only to the money that they put in the deal and any money that money makes. So your passive investor can't go past zero.
So with the syndication, let's just talk for a second, syndication versus a joint venture. Joint ventures, really, you're interacting with somebody that everybody's active. Syndication, you have actually a passive investor. You have an investment. What can you define what an investment actually is?
Investment, well, I'll use the more legalese term, security. And basically, any passive investment, intangible passive investment, is a security. The Supreme Court back in the 40s gave us what's called the Howey test, which is the test for what's a security. And that's an investment of money into a common enterprise with an expectation of profits from the efforts of others. In other words, if you're putting money in a deal and you expect someone else to make that money grow, you are buying a security. So the difference between joint ventures and syndications is that syndications involve a securities transaction, a sale of securities to a passive investor, the passive investor investing money into your deal and then doing nothing else. They put the money in and then they wait and hope that they make more money later.
What other options we got here?
I'm going to talk more about syndications here in a minute, but let me just kind of tease funds real quick. And funds, also known as blind pools, and reality, from the security standpoint, there's not a lot of difference between a fund and a syndication. The big difference is on the investor experience, in that the investors don't know for sure what investment is going to be made at the time they put their money in the deal. So a deal may have criteria. It says, oh, we're going to invest, let's say it's a real estate fund. We're going to invest in multifamily property in Texas, Mississippi, and Florida, garden style B-class properties with at least 100 doors. So there's no specific property for me to drive by and look at to decide, does this look like a good neighborhood or whatever. I just have criteria, and I have a deal sponsor or a GP asking me to trust their judgment to make good investments within the box that they've carved out as their investment criteria.
And I think when we go through that, it's I love funds mainly because it gives you the flexibility to pursue whatever makes sense. But at the end of the day, you have to draw this targeted acquisition box. And it's really important to know that the smaller the box, the more targeted the funds, the more attractive it can be to investors. And if you think about it, if you're asking for an investor for money, you're saying, hey, I'm just going to go buy anything. I'm going to do anything. You're just going to have to trust me. You're going to lose some investors just with that seems a little risky, putting all my faith into you. But at the same time, if you say, hey, I'm going to buy multifamily in Texas, Florida, or North Carolina, then all of a sudden the investors get to say, you know what, I like multifamily. I like these areas. Even if it doesn't go well, I have faith in the market. Even if you don't manage the projects well, I have faith in the markets.